that Hormuz highlights for us every day at this time. Rajesh Kothari is with us, Managing Director at AlfAccurate Advisors. Rajesh, good to have you here. By the way, Welspun Corp numbers just flash at the bottom of the screen, and numbers look, that's a pipe maker, largely in the oil and gas segment, and numbers look very good. EBITDA is up 40%. I'm not sure if there are any expectations on this one, but at least on an actual comparable basis, the numbers look super strong. Rajesh, good to have you with us here. Lots of these mid caps performing quite well, even though overall, when you look at the headline picture, one is not enthused, but it's all about single stocks, which you focus on as well. What has come to your attention where you've been really positively surprised in terms of earnings from individual companies, Rajesh, so far?
Well, I think there are two things. One is I was just looking at yesterday market Friday close, and exactly 1 year back where market was. And if you look at it, the BSE 500 is up 0% on 1 year basis. Friday to last Friday, I was comparing 25th July. Similarly, BSE mid and small cap index is also 0%. So while of course 0% is not a great news, but at the same time, when you look at this 0%, considering the macro uncertainty, the global geopolitical uncertainty, the tariff wars, and still markets are not down. So market is resilient. That's number one. And number two, when you look at the earnings, I think the two bad sectors where we are expecting the highest pressure on earnings, particularly software sector and the large part of the banking sector, that is over. These are the two sectors where we were expecting the highest pressure on earnings. Software because, of course, the global economy is still under question mark, and banking because of the net interest margins expected to be under pressure. But I think as we move forward in this earnings season, more capital goods results, by and large, we expect to be a little bit better. We expect specialty chemical numbers to be a little bit better. Select consumer companies, you have seen yesterday, 3 companies have announced their results, and all 3 have reported reasonably good numbers. And I think you will see more of such trends going forward. And these are the select baskets which are going to be the winners from this quarter perspective. So a lot of interesting, numbers are out. Many of these companies, EMS companies' numbers have been fantastically well. Few consumer durable proxy companies' numbers have been exceptionally good. So I think that's a trend, and we are rightly positioned, in those sectors.
Any new purchases at AlfAccurate Advisors, Rajesh? And also wanted to quickly get your thoughts in on Coforge. I know it was a stock that you liked. Explain to us what exactly about that data center capex that the street didn't like, because the stock reacted very sharply on the downside despite seemingly very strong growth numbers. So first tell us, what have you bought recently, any new ideas or you've doubled down on, and then even on Coforge.
Company specific, we generally do not talk much, but in terms of the addition, particularly in last 3-4 months, rather than just last 1 month, we have been adding EMS names to our portfolio. Specialty chemical, we have added huge in last 12-15 months. From 0%, it is almost like 9-10% of the portfolio. And capital goods is one sector we continue to remain positive. Coming specific to the IT company name which you talked about, please put a disclaimer because we are holding Coforge for our clients' portfolio. I think, I do not agree with how market has reacted. The companies delivered fantastic numbers, number one. And coming to the data center related capex, good part of that capex is already funded by the client. And as a shareholder, what I'm always looking for is the companies which can invest and reinvest their capital in higher ROCE businesses. Rather than giving us dividend or keeping it as a treasury and earn other income of 6%, I think it is a great decision what Coforge is doing. They are taking very, very prudent approach in terms of capital allocation. And the capital what they have invested to get this deal is going to be good margin accretive on net basis, and also ROCE accretive, more importantly, on the net basis. In fact, I'm sure we all basically keep thinking that why not the big IT companies in India? We do not have our own Indian Alibaba and many of these companies which have become globally number one, but we don't have Indian companies. But when Indian companies keep investing, and if we punish them, then I think that's the wrong way to look at it. The ROCE of this business is very, very healthy. And even on incremental ROCE basis, we expect, I think the Coforge is taking very prudent decisions. So I'm not, too negative about, or I'm not concerned about this decision. And, I think it's a good decision in the interest of shareholders. And they are one of the highest growing company if you look at last 4-5 years, despite various macro challenges what company has faced.
Rajesh, just to be clear, when you say that it's a good high ROC business, you're talking about the move on data centers that Coforge has taken, right?
Yeah, because if you look at the total investment, and if you look at how much client has already paid to them in terms of the upfront, the net investment what Coforge is making is not very high.
You know, just to put those numbers, the company spoke about an $85 million capex, of which the client is going to give them $63 million. So the amount that Coforge will be investing is about $22 million, which is what, like, 150, 200 odd crore rupees.
And that's a strong argument that Rajesh is making, that now everyone's complaining, saying IT companies, large IT companies at least, they've not invested in new businesses, R&D, etc. And here's a company that's trying to do that. And the market is punishing it. So fair argument there. So that's Coforge. Rajesh, last I remember, you also own Trent. So just give us your thought process there, because again, market getting extremely negative, saying, what is this 20% growth? I mean, it's not even 25%, which Trent said in the investor call, and the stock was punished. On the other hand, look at an Eternal. Again, I'm talking about consumer. I'm not sure if you have an exposure to something like Eternal. But just tell us about both these, high growth businesses. What are you thinking about platform companies like, say, an Eternal and Swiggy? And are you still keeping the faith on Trent?
So, well, I think, from the Trent perspective, again, please put a disclosure because we have been holding Trent for quite some time. I think it is one of our top holding from last almost 4 years. Of course, we keep rebalancing our portfolio over a period of time. So, I think what is happening should be from market perspective, the reactions and response time is getting shorter. And everybody would like to be ahead of time. And at the same time, a small marginal disappointment that leads to 10, 15, 20%, correction. And of course, everybody then comes out with a report of downgrade. Now, think of it, if suppose 2 quarters down the line, because thanks to income tax cut given by the finance minister, the liquidity boost given by RBI, if there is a 2% positive surprise, even today, it is the fastest growing consumer company in this country, correct? It is and you compare any other FMCG company or any other retail company, and if you look at this company which we are talking about, it is reported the fastest growth. But yes, the valuations and the PEG basis, how one looks at it, and some downgrade definitely results into, some disappointments. So as a fund manager, we need to be active, we need to be agile, and we need to make sure that we have a prudent exposure. So we also keep adjusting our exposure depending upon our bullishness on the stock. And, that's the real life. But frankly speaking, in my heart, I still believe that a company is rightly positioned to deliver the best of the growth compared to the entire consumer universe.
All right. Hi, Rajesh. Good to see you. And any view on these pipe makers? Welspun Corp, actually, these numbers look quite strong because the EBITDA number has come in at around 525 crores, which is the highest quarterly run rate we have ever seen on Welspun Corp. And the margins, it appears that the beat has come because of the gross margin expansion, because there is some inventory gain, it appears, which has come at around 43% approximately. So Welspun Corp clearly is a stock that's walking the talk now. Over the last few quarters, they have moved from a 350 crore quarterly run rate to around 525 crores. And it definitely appears that they're executing some part of those US orders, which were absent in the last many quarters. But now in the next 8 quarters or so, they'll get executed. Rajesh, any view on this particular name?
We do not own this company, but what happens is that as the US oil and gas sector's capex restarts, and that's what is happening from post-Trump coming in and the orders which are likely to get restart, this company, because they have a good exposure to US business, which is a high margin business compared to the Indian business where the order book is still not growing if you look at last 3, 4, 5 years. And because of this change in that fortunes, particularly in the US side, which is a high margin, and also the incrementally higher order book growth prospects, which is very likely. That's what Street is expecting. And that's what results into this better delivery from the company perspective. But this is my, the limited views because we do not own this company in our portfolio.
Okay, all right. Rajesh, stay with us, just coming back to you. But maybe we can quickly get in Mangalam, who's with us as well, with what's the latest as far as the F&O space is concerned from the F&O desk. Mangalam, tell us.
Well, you know, there is a sharp recovery that we've seen for the markets, and the indices have come off low, sharply off the low. So we have the Nifty doing well, we have the Nifty Bank doing well, and we have the mid-cap index doing well as well. But the sharpest reversal that we saw are on a couple of parameters. One, if you look at the advance decline ratio, at one point we had more stocks declining than the number of stocks which were advancing, and that has veered away once again. The lines have intersected, and if the green and red lines come up for you on the screen, you would see that they are fairly wide apart, almost 1,600 stocks in the green for a very small number which is in the red right now as compared to what we saw in the middle of today's trading session. The other thing that we're looking at is the India VIX. From a low of around 10, you know, the India VIX rallied all the way up 21%, and now after today's up move, a reversal from the lows, the India VIX itself has come down. So currently sitting at the lower end of today's trading range with a cut of almost 4%. At one point, remember, the India VIX was higher by around 4.5% in today's session as well. All of this can be attributed to one big stock. Look at Reliance. The intraday chart of Reliance comes up for you up 2%. That's powering the cause of Nifty, and also supporting it is the recovery that we've seen on the Nifty Bank, though still slightly away from the 50-day moving average for the frontline banking index, that is. What's also aiding the up move that we're seeing in the market, remember, it is sensex monthly options expiry, but at the same time, those in the morning would have written the 25,600 call on the Nifty. They've been caught on the wrong side, so they are swiftly covering their positions, and they're turning put writers. So, you know, the support for the market is coming higher. 24,800 puts fairly active, 24,700 puts equally active as well. So as you can see, you know, short covering of the 25,600 call and writing on the 24,800 and 700 put, telling you that around 24,650, 24,700 is an important support to watch out for after the recovery that we've seen today. The put-call ratio, which was oversold at close to 0.7 times, fell all the way to 0.64 times. That too has bounced back to around 0.77. And I'm watching out for a couple of stocks. In the last hour of trade, some long positions added on Asian Paints after the numbers. Street expects the worst to be behind. We have Syngene as well, which is fairly well bid on the future side. So fairly, high long additions is what we're seeing on Syngene. And finally, IEX. The threshold is 95% for a stock to go into F&O ban. The open interest is now at 94.77. So if it continues to see open interest addition, then chances are that IEX goes back into F&O ban. That's a stock I'm watching out for.
All right, Mangalam, thanks for that. That's F&O for you, and a few names on that side, derivative side, to keep an eye as well. Rajesh is with us. Rajesh, open question to you. I think we always do that. Anything new on your radar, Rajesh, apart from what we've discussed? Maybe you've added or you're watching closely?
Well, I think the CDMO space we continue to like, and with the new companies which are getting listed recently, we are following, we have been quite positive on CDMO as a space. Building material is another segment which is coming out of the bad times, particularly if you look at the tiles and the plywood side of it, so they're probably likely that the worst is over, and there are a lot of tailwinds which can start because whatever real estate you have seen the boom in last 3.5, 4 years, that is primarily the registrations. And now it's a time for handover of delivery, the actual position to the customers. And as that happens, it means next 24 to 36 months can be in your favor. And that can lead to revival in demand, in the building material space. And at the same time, certain raw materials within this building material, you are seeing the downward trajectory. So your volume growth is going to come back, number one. Therefore, you get operating leverage, number two. And number three, your raw material prices are coming down. And therefore, the competitive metrics, as well as the fight for market share, also comes in your favor. So net, your revenue growth and profit growth can be much stronger over next 12 to 24 months in the building material space in particular. That's the one segment which we like. And the second segment, which I've been talking about is the retail side of the apparel side of the business, the fashion side of the business. And there we believe that from September, October quarter, probably you will see the much better uptick in terms of the revenue growth, particularly for the branded players. And in fact, if you look at one of the companies which reported numbers yesterday, it has shown very strong 15% revenue growth, which has not happened in the last 8 quarters for the entire industry. So I think that is also probably bottoming out. The worst of I would say the fight of market share between e-commerce and the non-e-commerce players is also probably behind us. And therefore, even you might see some uptick over there. So net, the consumption basket on the discretionary side, within that to these sub-segments, that's what probably we believe that they're likely to do much better compared to what we have seen in last 2 years.
CDMO, you're talking about, were you referring to Anthem, which is a recent CDMO listing?
Yeah, I mean, I think the entire CDMO space will do well.
Okay.
We've been holding CDMO companies, and the new companies as well. They are quite exciting business models with the strong revenue visibility.
Okay, Anthem's done well since listing from that space. So retail, apparel, building materials, and CDMO, specific pockets there. Rajesh, thank you for your time. Good speaking with you here on CNBC TV18. Just a quick reminder for our viewers as we go into that break. You can unlock a world of exclusivity, expertise, and